Good morning. It is Wednesday morning, 9 o'clock, and you know what that means. It is our Ignite Girls, Ignite & Co., where the elite go to grow, our 9 a.m. coffee talk. I'm Shelly Borman.
I'm Lisa Gustafson. I'm Erica Benigni.
And today we're here to talk to you about it's something that we've heard a lot in this market, especially in the last couple of months. People want to know what they can do to make a non-contingent offer to buy a new home. So what does that mean? When you make a non-contingent offer, that means that you're letting the seller of the home you want to buy know that you do not need to sell your current home in order to qualify to buy the new home. That's a non-contingent offer. That's a stronger offer in today's market.
Yes.
So there are some different strategies to be able to do that. You know, we can look at bridge loans. We can look at HELOCs or home equity lines of credit. And so, Lisa, what are those?
Yeah, so one thing to know if you're going to make a non-contingent offer, you generally are going to need to qualify for both payments, the payment on the old house and the payment on the new house, and any HELOC or bridge loan that you get as well, the payment on that. But besides that, you have the other issue of the down payment. You have to have the down payment for the new home. Now, it doesn't have to be the full amount. If you were planning to sell your home and put down $400,000, that doesn't mean you can't purchase the new home unless you have $400,000. A lot of times we'll do a minimum down on the new home. So, 5%, 10%, 20. And then when you sell your existing home, you can put down the additional funds, which is a whole other topic for another coffee talk. But one way that you might have those funds for the down payment is if you have a home equity loan or a second mortgage on your house. And so there's a lot of confusion, I think, for people on those terms. A lot of times you hear them and they get thrown around a lot, but you don't really know what the difference is. So a HELOC is a home equity line of credit, and a second mortgage is more like a fixed or installment loan. They're both liens against your house, generally being placed as a second lien position after the first mortgage. So when you sell your home, any liens that you have against it, first mortgage, second mortgage must be paid off. So the same with this. So it's secured financing against your home, which makes it acceptable for down payment on a new home. So that's one really common use for a HELOC. The home equity line of credit is generally an interest-only payment. And so you're paying interest only based on the amount that you've drawn. So your HELOC might have a revolving line that is, let's say you had enough to put $50,000 against the home on a HELOC. If you drew $20,000 out one month, which is generally very easy, you write a check or they have even a credit card sometimes, then you will pay interest only on the $20,000 that you've drawn. So if you have a home equity loan in place and you haven't drawn any of the funds, you don't pay interest. So you could get that in place, and a lot of people do, and it's a great strategy, and have it out there for kind of rainy day or investment purposes. And until you actually pull the trigger and draw money on it, you're not paying anything for it besides the initial setup costs, which generally are $500 to $700 maybe for a HELOC or a second mortgage.
And let me interject really quickly. So it's typically interest only during the draw period,
Yes.
which tends to be around
Usually
10 years.
Yep.
And then you have either 10, 15, or 20-year repayment period.
Yep.
It's really different depending upon the different institutions.
Yep, exactly. And draw period just means the time frame that you're allowed to draw the funds. So you can draw, pay it back, draw, pay it back, generally as many times as you'd like. So that's a revolving account. So HELOC is like a revolving account, where a second mortgage is like an installment loan. Generally speaking, the interest rate is fixed. All of the money is advanced at once. So if it's a $50,000 loan, you get all $50,000, and then you make payments each month, generally principal and interest, usually over 10 years, 15 years. Sometimes it's a 30-year amortization that balloons in 7 years. As always, interest rates, or not always, but generally speaking, interest rates on second mortgages are going to be higher than first mortgages. So that's just to be expected because it is a second lien position, so there's more risk. If there's more risk, the rates are higher. Right? So a HELOC or a second mortgage can work if you have it in place ahead of time as a way to make a non-contingent offer. But if not, then you can do a bridge loan.
So one of the things that I typically ask my clients when they are inquiring about options to go non-contingent is, do they already have a line of credit in place on their current home? And if so, what's the limit? Do they have a balance on that? So a HELOC, you can have that in place years in advance. And I encourage a lot of my clients to do that because, again, you are only paying interest on what you use. So you can have a line available of $100,000 in equity on your home and only pay interest when you use it. So the bridge is a little bit different because the bridge is a lump sum of funds. So the bridge is basically identifying that you're already in the process of, you've identified a house that you want to buy, you're selling your house, and you need to bridge that gap. So the bridge loan is going to take equity from your current house for you to use for down payment on the new house. And as Shelley mentioned, you do have to qualify for, when you're doing non-contingent, you have to qualify for the payment on the current mortgage, the bridge, and the new house.
Right.
So every institution is a little bit different on the qualification, but something to keep in mind. The other differences with a bridge loan, they're short term, so they are typically 12 months that they have to be paid back, which again, your intention is you're selling your house. And so a lot of times you may not even have the bridge loan more than 60 days. Yeah. Payments are often interest only. Closing costs on a bridge loan are a bit more expensive. And really the reason for that, it's short-term money. So you're going to pay most likely 1% of the loan amount. And then you've got third-party fees paid to the title company, recording fees. Bridge loans typically do require an appraisal and can take about 30 days from start to finish. So something you need to keep in mind in your timeline when writing an offer, if it's going to be non-contingent with a bridge. So you could potentially put a bridge loan in place sooner than later. You could put a bridge loan in place before you make an offer, knowing though that it's going to come due in 12 months. Yes, so
For sure.
I think those are the main differences between a bridge, a home equity
Right.
line, and a home equity loan.
Yeah, I think generally speaking, we go the home equity option first because
If we
that's
have
going to be less
time.
expensive,
Yeah.
right?
Yeah.
And then if the timing doesn't work, then the bridge is another option.
Yeah.
But the big thing is, if your clients have questions about this, send them to us. We can help get them hooked up. We can help educate, and we can help plan for the long term as well.
Yes.
You know, if you have a home equity line of credit, I think it's been said, Lisa said that these are variable interest rates.
Yeah.
So these rates are going to be going up. And maybe it makes sense to get a home equity line now. Once you finish your basement, whatever you're doing, do a cash out refinance later.
Depending on rates.
Yeah.
Yeah.
So we'll look at the long-term plan.
Right. We'll make
But-
it work.
Yeah, exactly. So thank you for joining us
Thank you so much.
this morning. Join us next time for your Ignite & Co. where the elite go to grow. Our goal is to help you do more business.
Have a great week.
Cheers.